In this video for ithought Advisor, I am going to talk to you on the topic taking fresh stock. For the last 2 years, interest rates went down first and are now rising. During this phase, there are many people who left debt investing to come to equity investing. The reason was simple. They wanted to beat inflation and returns from debt investments were terrible. They were too low. So, purely chasing returns, we have a section of investors who came to equity. These investors are traditionally debt investors. Very rarely have they migrated from debt to equity, and it's doubly rare for them to come and invest so aggressively in equity. What is their experience? Initially, the experience was very good, but as time progresses, they are really not getting the benefit of shifting from debt to equity. They are underperforming inflation. So, the reason to come from debt to equity has really not been justified. Now, it's more difficult for them because debt market returns, investments in debt are now beginning to yield much better and very closer to their aspirational return. This is definitely making a lot of people think that maybe we should just be in our comfort zone and we should go back. By that, many people are now coming around to the view that they should sell their equity and go to debt or put all fresh monies back only into debt. We are at the cusp of another interest rate hike and debt investments are only going to become all the more attractive. And if and when inflation starts coming down, we will still see the interest rates remain stable. I don't think interest rates are going to go down in a hurry. This would make the case for debt increasingly more compelling. So, as time progresses, more people will head back to debt and more new monies will be comfortable going into debt investing. So, we will see a reallocation of money and a consolidation of fresh money in debt. This is something which is not a usual occurrence. We have always seen money move from equity to debt, but now we are going to see the reverse. It's not something people are familiar with in recent times, and it's something which can only become stronger as a trend. So, investors must take stock of the relative merits of debt and equity and ensure they are adequately allocated to both. It's important to ensure that your debt portfolios are built as interest rates rise and reach a peak. Once rates touch a peak and start descending, your returns from debt products should further increase. Falling interest rates should give you capital gains in your debt investments. All this has to happen over the next 3 years. It's important that investors take fresh stock of their strategies, decide whether they still want to continue in equity or be as aggressive in equity as they were a year ago, evaluate the relative merit of debt investments, get a strategy ready to invest in debt as interest rates go up, build a portfolio of debt investments in a phase of rising interest rates, ensure that you complete this portfolio by the time the peak is touched and interest rates reverse, and make sure that your decisions are made conservatively, correctly and rationally. Thank you for watching this video.